Okay, in this video we're going to be looking at the difference between short run and long run trade-offs and how businesses conduct what we call a cost-benefit analysis. So it's very similar to looking at trading off the current for the future, but when we're looking at short-term and long-term trade-offs, we're looking at what the trade-offs are over certain time frames. So generally refer to the short-term as in the next 6 months, so will decisions benefit or hurt us in the next 6 months? And the long run is generally beyond a year, although often we refer to the medium term as between 6 months and 3 years, with the long term being longer than 3 years. So the short run is generally a period of time that is close enough to heavily influence decision making today, whereas the long run is that period of time that is far enough away to have a smaller influence on today's decision making. So generally over 3 years is considered to be the long run. So often consumers and businesses and the government need to make choices which have trade-offs between current consumption and future consumption. So for example, right now, a trade-off that a consumer might face is the decision to get a job straight after going to school rather than attending university. So they would do a cost-benefit analysis, and the benefits of getting a job would be the higher income, the less stress from studying, whereas the cost may be the fact that they lose future income, because they don't have the opportunity to get maybe a more high-skilled job. They also lose the ability to make the friends they would have got in uni and the experiences that they would have received out of university as well. Another good example of a trade-off between short and the long term is installing a solar panel. So in the short term, it may have negative implications for families because the startup or initial outlay is really expensive for solar panels. That money could have been spent on a new family car, it could have been spent on a holiday, and therefore the opportunity cost can be quite high in the short term. And the sacrifice can be quite high in the short term. But in the long term, the benefit may be that they have cheaper energy costs. So once they have the solar panel installed, they don't have to pay for energy. It can come from the sun, and therefore they're saving thousands of dollars each year. So that's an example of trading off the short term for long-term benefits. For businesses, generally we're looking at the short term where their factors of production are fixed. So what we mean by that is we're looking at the short term as what they can do, what they can produce with their current factors of production. So before any sort of investment into new capital or new machinery or anything like that. So an example might be that if you choose to expand your productive capacity by investing in new plant and equipment, you're getting benefits in the long term because you're going to generate higher sales, you're going to be able to produce more efficiently, but that may cost in the short term because it's going to be initial outlay. And you may have less profit that's available to give to employees or to keep for yourself as a owner of a business. Other firms that choose not to expand and focus on the short-term benefits, so e.g. keeping their debt levels low, protecting their bank balance, may trade off the potential benefits from having a larger business that can respond to demands and make more profits in the long term. So other examples of short and long run trade-offs, the government reducing their exploitation of natural resources, so by the government having things like a carbon tax or subsidising clean energy or reducing how much they're exploiting the environment, that can have the long-term benefit for supply because we protect our agricultural resources. It's going to be good for tourism because we don't hurt the Great Barrier Reef and things like that. The Adani mine is a good example of the short and long-run trade-offs, which we'll talk about later in the year. Another one might be economic growth. So if we aim to stimulate economic growth in the short term, that can come at the expense of our long-term needs because it can cause carbon pollution, and which can cause climate change and have negative implications for society. Another one is the government tries to stimulate the economy to create jobs. So when we talked about, for example, giving everyone $950 as that stimulus package, that had a short-term benefit helping us to stimulate spending and avoid recession. But it can come at long-run costs because it can hurt the budget, mean the government go into more debt, and it can also lead to inflation if it increases spending by too much. Some examples of the trade-off between short and long-term benefits. Whenever we make a decision, businesses will conduct what we call a cost-benefit analysis. So all economic agents aim to minimise their opportunity cost, and before they undertake a project, they need to weigh up the costs and benefits before undertaking that project. So a cost-benefit analysis is a comparison of the expected costs and benefits of a particular course of action. It's mostly done quickly without technology, so we do it every day when we decide to purchase products, just mentally in our head. Examples of cost-benefit analysis, so for consumers, they might weigh up the costs and benefits of smoking a cigarette. So a cigarette might provide short-term benefits, reducing stress, you might think it makes you look cool, but it can also be outweighed by the long-term costs in the form of poor health, emphysema, can cost you financially if you have to pay for operations. It can hurt your family. So most people refrain from smoking because their cost-benefit analysis says to them that the long-term impacts on their health outweigh any short-term benefits. Another one would be the government. If they decide for the construction of a new road or railway, they will basically do a long and lengthy cost-benefit analysis and put a whole range of different inputs in, get advice from a whole range of different professionals to seek advice because it's a multi-billion-dollar decision. So unlike you determining what you have for lunch, it's something that has an impact on a whole range of different people, has an impact on the government, those that can lose their houses, those that are going to benefit from getting to work faster. So they will do a lengthy cost-benefit analysis. And basically what they do with their findings is if they determine from their cost-benefit analysis that they get a figure of greater than 1, so they have put a numerical value on all the benefits, dividing that by all the costs, and if it has a ratio of higher than 1, it means the benefits outweigh the costs. If it has a ratio of less than 1, it means the costs outweigh the benefits. The problem with undertaking cost-benefit analysis is many of these costs and benefits are non-monetary in value. So it could be, people losing their family homes. It's very hard to put a price on that, and therefore it can be a subjective exercise, trying to convert monetary values into things that are not monetary in nature. So, for example, the East-West link, a lot of people still think that should have been built, but when we're weighing up whether it should be done, we need to weigh up the loss of some public parkland, which is very hard to put a price on. The loss of parkland will affect some more than others, but it's hard to have an exact monetary value on how much benefit people get from being able to enjoy the park, walk in the park, kick footy in the park, etc., etc. So governments and organisations will still seek to do cost-benefit analysis to try and minimise their opportunity costs, but it can be very hard to ensure that projects are always achieving allocative efficiency. Thank you.